get started. Everybody, we welcome you to the exciting world of multifamily meetup. We are XSITE Capital, the host of this meetup, and I am Julius, the CEO and co-founder at XSITE Capital. Co-hosting with me today is our fantastic Director of Acquisitions and co-founder, Mr. Tenny, and our wonderful co-founder and Director of Operations, Mr. Leslie Awasam. We also have other team members, Braden Haid, who was not able to join us today, and others that make XSITE who we are. We aim to partner with our community of investors to purchase and acquire cash flowing multifamily asset, and we've been doing that with significant success for the past 2 years, including our deal that we have on the contract right now. We have about $125 million of assets under management and are fast growing that portfolio. Today in particular, we are super excited to have Yonah Weiss join us. Yonah is definitely, is a force to be reckoned with when it comes to properties owners' tax savings. He's the business director at Madison Specs, which is a national cost segregation company, and he has assisted his clients to save tens of millions of dollars in taxes through cost segregation. He definitely also has a significant passion for teaching, and he is an incredible teacher, particularly when it comes to the topic of cost segregation. And he's one of the foremost experts. And if you are a friend or connected to Yonah on LinkedIn, you would know that he's very vocal and very, very active in the space. He's literally the number one go-to expert when it comes to cost segregation for many of the teams doing this. So without wasting any further time and without further ado, it's our pleasure to welcome Yonah Weiss to the exciting world of multifamily meetup. I know you guys are in for a real treat today, and I look forward to the exciting discussion right after this presentation. So Yonah, please take it away.
Thank you so much, Julius. What an introduction. I mean, seriously, I don't think I've gotten such a great introduction in a long time, but I appreciate that. It definitely.
Hey, Yonah, I think your computer just froze again.
Yeah, I think I'm getting some like sign here that I have something's wrong with my connection tonight. I don't know what's going on. We're good. We're going to keep it rolling. Don't worry. We go through the, you'll just fill in when I freeze up there.
No worries. I'll be ready.
But you're absolutely right. I mean, Madison Specs company I work for is the largest national company. I certainly have a passion for conservation, have a passion for helping people in general. Hope that shines through. And really what we're here tonight is really just to discuss this topic, which I think for a lot of people is really confusing. Don't really know what it is. What it's talking about doesn't even apply to me. Can I benefit from it? Can I not? And I think you guys know, firsthand, we've done some work for you, and you've seen firsthand the incredible tax benefits that come along with it. But I'm here to answer any questions and really clarify all the points that hopefully we'll discuss tonight. So if you'd like, I have a presentation, a slideshow. Is that what we should do? Yeah. No. Absolutely. Yes. No.
Yeah. Why not? Let's do it.
I don't know. Okay. Leslie shaking his head. You're okay. We'll do it. Let's just share the screen over here. And as I said, I tend to talk a little fast. If you do have any questions at any point, please put them in the chat box or stop me and let the guys know, and we'll stop and make sure to cover that. Yeah, let's just share the PowerPoint over here. So I'm going to share this, but I'm not going to be able to see who's there. We'll get the spotlight on so you can see my finger over here. And then let's, yeah, what's going on? A slideshow. Oh, got to move this. There we go. all these sidebars over here. All right. This is, yeah, well, I'm excited because this is the exciting world of cost segregation, the exciting tax benefits of cost segregation. It is exciting because, you know, when you learn about it for the first time, you know, you're kind of blown away that something like this even exists in the tax code, right? And when you learn more about it and you find out, wow, this can actually apply to me, and I can actually, as a real estate investor, pay little to no taxes, literally, this is something that is mind-blowing. Now, I will preface with the fact that this is not necessarily for everyone, and not everyone is going to benefit equally. But that's the case when it comes to tax savings. Not everyone benefits equally, but hopefully we'll clear up some of those misconceptions as well. What our plan tonight is to cover a few topics, and really in general, we're going to cover cost segregation, which is really just depreciation. It's just a weird, you know, kind of name for a advanced form of depreciation. We'll talk about what that really is, what are the benefits. Bonus depreciation, anyone heard of that? Yeah, probably. And then who should be doing this? But before we do that, I'd love to just open the chat for a second. And I don't know if I can even see the chat anymore. Yeah, here we go. Here's the chat box. Before we do this, yeah, thank you, Jay. Yeah, got a regular broadcast, which we got to get you guys on there as well. Weiss Advice Podcast. Love to have you guys one of these days. If you can, please open the chat box, and everyone here, just so I know where you guys are holding. I'm going to ask you to write number 1, 2, 3, or 4. So number 1, write the number 1 in the chat box if this is the first time you've ever heard of cost segregation, when you heard about this meetup tonight. Number 1, again, this is the first time you ever heard of it. Number 2 is that you've heard the name, you've seen it before, but really have very little idea of what it really is. That's number 2. Number 3 is you know very well what it is, and in fact, you've probably used it yourself, so you've benefited from it. And number 4 is going to be you're actually the cost seg expert, and I'm going to hand the stage over to you. So I'm looking out for a 4. We got 1, 2, 3, and 4. So number 1, don't be shy if this is the first time you ever heard of it. That's okay. So Leslie is you should be like a 2.5. 2 is, you know what it is. You've benefited also, but I actually got it done. So we got mostly 2s and 3s. So you guys know what it is, heard of it a little bit, but don't really know a lot about it. I think majorities are 2. So I'll take it slow. Don't worry, if you do have questions, feel free to ask. And like I said, this is going to blow your mind. If you know, it's really going to blow your mind. And I think we'll all agree on that. Where we're going to go with this is like this. We're going to do a little case study as well, but I do want to just talk in the real estate professional. And this is really the number 1 thing that you're going to want to learn about tonight. Probably the biggest mind-blowing thing is going to be learning about this real estate professional and what that's all about. But the first thing we're going to do is talk about depreciation. Now, depreciation sounds like a negative word, right? Negative depreciation, going down in value, right? Everyone knows what that is. You want your property to appreciate, right? You want it to be going up in value. And in fact, it usually does. Depreciation, let's just take this as it is. It's a borrowed term, okay? When we're talking about tax deductions, talking about real estate, depreciation, tax deduction is a borrowed term. It is a tax deduction the IRS gives you when you buy a property, investment property, rental property, anything, business property. As long as it's not your personal residence, you get to take this tax write-off, this tax deduction, income tax deduction called depreciation. It's based on the concept that things go down in value as time goes on, but it's not really intrinsic to the real value of the property, because it starts, first of all, starts the day that you buy the property. You get to start your 27.5 year for residential or 39-year schedule, and it's based on the purchase price. Now, it's not the real replacement cost that we're depreciating, and the building could have been built in 1950, for all I know. But and so those years have long passed. However, you get to start that time line today when you buy the property, whenever that is. And so that's what I want to focus on. It's a borrowed term. Now, it doesn't mean that your property is going down in value. It doesn't mean that at all. What it means is that based on the principle things go down in value, the IRS has given you a tax deduction to help offset your income, because they think real estate investing is really great and we all should do it. And so therefore you get these tax deductions, right? That's pretty much what it comes down to. However, what we're going to talk about tonight is not just depreciation, but about this tax planning strategy called cost segregation, which is a really weird name, but literally what it means is breaking down or segregating the property into different categories that depreciate faster. Okay. So we're talking about things in the building. We'll talk very specifically shortly. what those things are, what those components are. Different components actually depreciate faster. And you can understand that, right? You know, you have to replace your carpet every 5 years or something. You have to replace appliances every a few years, things like that. They don't last as long as the structure. Now, even though, as we said, it's a borrowed term, and we're not talking about the real useful life of a property, because we're talking about the tax useful life of something. Nevertheless, the IRS says when you buy it day one, there are things inside the building that depreciate on a 5-year schedule, 7, 15, etc. So our job with the cost segregation is identifying and determining what those costs or what those values are, and getting those tax deductions for you, the property owner. So let's dive into that. Let's just take let's just take a quick example over here. Okay, let's say you buy a property for $1 million. Now, you always have to take off a certain amount for land. Land does not depreciate. And even though we're talking about 15% here, it could be 5%, it could be 10%, 20%. Even in places like California, where the land value is very high, it could even be as high as 50, 60%, which is crazy, but that's what it is. Regardless, you always have to subtract the land value. And that's usually determined from a property tax assessor or something similar, or a land appraisal usually have the land value. And whatever, we're using 15% because it's the national average. And what we're left with is $850,000. That means if you buy a building today, you buy a property, single family, multifamily, commercial, office, industrial, self-storage, doesn't matter what it is, anything that's not your personal residence, you get to now take a tax deduction of $850,000. Okay, but you can't take it all at once. What you can do is you can spread it over what we call straight line depreciation over 39 years or 27.5 years. And essentially what you're left with, what you're getting is $21,794 or $30,909, $20 or $30,000 tax deduction each year. How this works is an income tax deduction. It reduces your taxable liability, right? So when you buy this rental property for $1 million, right, how much rental income are you going to be getting? At the end of the day, hopefully if it's making money, let's say it's $60,000. Okay, it's a 6 cap, right? $60,000 on $1 million, that's a 6 cap. That means you're making a net profit of $60,000. Well, immediately you get to take a deduction of $30,000, which means you're only going to be taxed on the remaining $30,000. Okay, that's how depreciation works. Cost segregation, and we're going to get to shortly, how we're able to front load certain deductions into 5-year category or 15-year category. What that literally means is in the first 5 years, we can take from this pool of potential tax deductions. And instead of waiting 39 years or 27 years, we can actually pull some of those deductions, maybe 20% of them, into the first 5 years or even into the first year, and actually get these huge tax write-offs where not only are you going to be wiping out your entire tax liability, you can literally be getting extra deductions, tax losses, which in certain cases you can carry over to other income besides your rental income. Again, we will get to all of this shortly. Any questions so far?
Nope.
I see in the chat, Diane says, did apply self-storage at all? RV parks? Yes, any type of property cost segregation applies, and it will apply differently for different asset classes. As we will see, I'll actually have a chart later on, which will show you which type of asset classes benefit more than others. And so we'll break that out. Andrew asks, is bonus depreciation going to phase that? Yeah, I'm getting a little ahead of ourselves, but yeah, we'll talk about bonus depreciation and how that works and how it applies and how long it's going to be lasting. Okay, so far so good. So let's just recap quickly. I know there's a few people that joined until now. Up at this point, cost segregation, we're going to be determining how much the building costs, but how much is in each individual component. Okay, so really cost segregation used to be called component depreciation, which makes a lot more sense, because what we're literally doing is having an engineer identifying, and this requires an engineer component to it, meaning it's not just something you can just throw a dart at the wall, figure out how much this costs. When you buy a property, right, you buy this $1 million, $10 million, whatever it is, you don't know how much of that $10 million is allocated to the cabinets, or because you didn't build it, right? If you built it, you know. If you built a new construction property, you have receipts, you know exactly how much everything costs. And by the way, for depreciation purposes on a new construction, that's exactly what you're going to do. You're just going to use those actual costs and depreciate those. Cabinets, 5 years, carpeting, 5 years, whatever it is, pavement, 15 years. But if you have a new acquisition, it's not a new construction, to replacement cost to build this property maybe cost only $100,000 and you bought it for $1 million. So now how much Well, if that, in that case, it's, you know, a simple 10 ratio, but you understand what I'm saying. The challenge is identifying what all those individual components are based on their specific useful life, but also based on the total property as is now. So that's what we're doing. We're reclassifying them and taking these deductions at a faster rate. So here are the main categories we're going to be looking at when we're dealing with land, which does not depreciate. You have the building, the structural components, and that's always going to be the vast majority of the value in the property that depreciate on a 39 or 27.5-year schedule. Again, 39 for commercial, 27.5 for residential, including multifamily. So don't get confused by that, because for lending purposes, commercial is anything over 4 units, right? 5 unit and up, that's commercial. For tax purposes, 27.5 years is always going to be the case for multifamily properties, even if it's a 300 unit building, right? So that's what we're talking about. But all the other two categories, and this is the main things we're going to be identifying with the cost segregation, are things inside that depreciate on a 5-year schedule, personal tangible property, stuff that you can imagine, anything that's non-structural. So if you think about stuff like cabinets, shelving, lighting, carpeting, equipment, furniture, appliances, all this stuff you can imagine, but even things like millwork or window treatments, you know, vinyl floors, these are things that are attached literally to the building. Nevertheless, they depreciate on that 5-year schedule. And our job as the engineers is to identify how much of that exists in the property and what the value of that is. And then the second category here is 15-year land improvements. And this is a big one, because especially if you're dealing with, you know, large garden style apartments like the ones that Julius and Leslie are buying, although not the most recent one in Colombia, I believe, right? That's not so much a garden style, but the others, right? You have a lot of concrete, you have a lot of, you know, parking lot, you have a pavement, a sidewalk, walking paths, you have fencing, you have landscaping, playground equipment, swimming pool, all that stuff, you know, signage, etc. You have a lot of different things going on there that are outside and that all have value. And all these things, you know, our job is to identify what the value, how much square footage of all those things are, and then what the value of that. We're going to place a value, and you're going to be able to accelerate the depreciation of the deductions of the value of these assets to these earlier years. Okay, so that's really what, you know, in a nutshell, what we're going to be looking at for the most part. And there are obviously many different categories. These are just examples of things specifically in a multifamily property. There are other things that can be in there. This was just one example here. So, but these are typically what we're going to be looking for. We're going to be touring the property, touring the assets, and finding all of these individual components. Again, if you have like an office, for example, in that property, there are other going to be things in there that, you know, are going to be depreciated. You maybe have like computers and desks and equipment and stuff like that, etc. So this is really, really important to know what we're looking at when we're talking about these things. The other thing we want to talk about now is, well, actually, we'll get back to that in a second, but let's just recap again. I see people coming in every minute, you guys. I don't know how many people we're up to, but it seems like, you know, people trailing in. What we're, again, I like to recap every few minutes. And again, if you do have questions, please put them in the chat. We'll try to get to them. We're reducing our tax liability. Okay, I want to make it very clear. This is a very common question that I get. How much refund am I going to be getting when I do a cost segregation? Okay, people want to know, am I going to get a big tax refund? Well, the answer to that is probably not, because the cost segregation depreciation works as a tax deduction that works specifically against rental income, against passive income. Excuse me. Passive income, Schedule E income, is treated differently than your active or your W-2 or your Schedule C income. And so passive deductions are going to be used against that passive income. Now, if you qualify, as we're going to get to shortly about the real estate professional, we'll talk about that. You may be able to use that. You may be able to get a refund from that. But otherwise, if you have more deductions than you have income, what you're going to create is called a passive loss. Excuse me. Now, a passive loss is just extra deductions that you're going to be able to take. You know, it's going to show up as like a negative. You may have, if anyone's invested in a syndication or invested in real estate, you may have seen your Schedule K1, which is a tax form that shows you how many how much income you have and how many deductions you have, and they may show a negative number. You're like, wait a second, I lost money, I have a negative. No, you don't have a negative. What you have is you have more deductions than you have income. So number one, you're not paying any tax on any of the income you're making. And number two, you have these extra deductions that carry forward that you can use next year or in the future. But essentially what we're doing is reducing that tax liability, reduce the tax liability, which increases cash flow, excuse me. And the main thing here is the time value of money. Now, this is so much more appropriate now with inflation as high as it is right now, that having cash now that you can go and deploy and reinvest is more powerful than ever, because your cash, number one, being paid to the IRS is not going to help you. Number two, sitting in a bank is not going to help you, because the cash is literally being devalued by the day. And so having your own cash to be able to reinvest and actually create returns from it, it's probably more valuable now than I think it's ever been in our lifetime, at least. And I'm not that old, but for sure in my lifetime. So this was an example, and I apologize, this was kind of like an old example I pulled up years ago when I first created this. But what we're doing, again, is we're giving huge tax deduction in the beginning after cost segregation, and then it kind of goes down after 5 years. And then essentially you're not taking all of your deductions up front. What you're doing is, instead of, right, the blue line is without cost segregation, you would just have a straight line, $100,000 every single year for 39 years. With cost segregation, the first 5-6 years, you have a lot more deductions. And then afterwards, you have a little bit less. Because again, if you think about it, we're not taking all of our tax deductions from this pool of deductions right now. Maybe we're getting 20%, maybe 30%, but you still have the remainder, right? The 70-80% of deductions that you're going to be taking over that longer period of time, which you may not be holding a property for 20 years or 30 years. So obviously a much better reason to use those deductions while you can. So what is bonus depreciation? I know someone mentioned in the chat before it's going to be phasing out. So let's talk about what it is first before we talk about phasing out. There was something called the Tax Cuts and Jobs Act of 2017. People call it the Trump tax reform, which was probably the biggest tax reform in several decades. And one thing that it did to help cost segregation is this thing called bonus depreciation. So remember a few slides ago, we talked about the 5-year property, the 15-year property, stuff that depreciates faster. That's what we're doing with the cost segregation, identifying those things and taking them faster. Well, what this bonus depreciation came along and said was, you can now take 100% of this in the first year. Now, it was 50% for new construction. And what it changed in the tax reform was that not just new construction, it moved from 50% to 100% of those tax write-offs. Again, that accelerated depreciation. And I'll give you an example in a second, just to make it more clear. Anything under 20 years, meaning the 5-year, 15-year property, and you can take it all up front in the first year and for a new acquisition, not just for new construction. So for example, if we're taking 20% or 25% of our total depreciation over a 5-year period, that's great. That gets you a lot more over the first 5 years. Let's just make a simple example. Let's go back to our first slide over there. I probably should remember this $30,000. We had $60,000 of income. Well, let's say you did bonus depreciation and you're getting, $250,000 in the first year. Okay. Well, that $60,000 of income is going to be wiped out entirely. And then you have an extra, $190,000. What are you going to do with it? You can use that against other income, as we'll see shortly. So again, any of these 5, 15-year assets, you can take it all, those deductions in the first year. Okay. But as someone mentioned, it is phasing out, which means in the 2017 Tax Cuts and Jobs Act, it's set up in the books that this 100% bonus depreciation is only going to be lasting until when? This year. That's right, 2022. This is the last year to claim the 100% bonus. It's going to start phasing out 20% each year until next year. It's going to go down to 80% in 2023, 60, 40, et cetera, until in 2028. As far as the books are now, there's no longer a bonus depreciation. You can still use cost segregation, which has always been around and probably still will always be around, but getting that huge lump sum up front is no longer going to be an option. Yeah, thanks for that. Yeah, golden nuggets. There we go. So who should be doing this? Now, really anyone can do this, but we'll talk about who should be doing it in a second. Who should be doing this? Anyone really. If you're an individual, trust, corporation, doesn't matter, any partnerships. And oftentimes syndications are made up of a group of investors, general partners, limited partners. We have different investors, and the depreciation is usually, and there are different structures, but most likely, most common structure is that it's going to be spread equally according to your percentage of ownership. Okay, and I see this being advertised in different syndications of things. If you put in $100,000, you're going to get, $80,000 of bonus depreciation, or 80% or 100%. How is that possible? Because what we're talking about is the purchase price, right, establishes what that depreciation is. Well, if you buy a property with a lot of leverage, okay, with a mortgage, and you're really only putting down a 20% and taking 80% from the bank, well, you still get 100% of the depreciation, which means based on the purchase price, which is how you can have 20% equity, okay, and if you're getting a 20% bonus depreciation, that means 100% of your equity is going to be returned in that bonus depreciation in the first year. So that's usually how it works. Obviously, the less leverage you have, the less that ratio or percentage is. Now, the one case where I will mention where you're not going to benefit from this tax deduction of depreciation, cost segregation in general, is if you're not taxable. So if you're investing from a nonprofit or government agency, or a very common thing is a retirement account. Or a lot of retirement accounts out there, like Roth IRAs, right? QRPs, they call them, qualified retirement plans, or 401ks, et cetera. It's a great thing if you have those. You can actually self-direct them and invest in real estate. And I highly recommend you do that if you have the right provider, right person doing that, who knows what.
Yeah, I think Yonah is
You can't benefit.
Oh, there you go.
Oh, did I freeze again?
Yeah, just briefly.
That's all right. So again, make sure you have the right provider, but remember, if you already have a tax shelter, you're not going to be able to benefit from cost segregation. So for anyone who's a syndicator out there, or aspiring syndicator, if you're taking funds from retirement accounts, just be aware that they're not going to be able to benefit from. Most likely, there are certain types of retirement accounts like self-directed IRAs that could, but again, they're going to be subject to a different type of tax. I don't want to get off on that. You can have someone like my good friend Bernard Weiss, who's an expert in the field, talk about that at a future meetup if you want. But essentially, those are people who are not going to benefit from cost segregation. Otherwise, the real question is going to come down to how much rental income, how much passive income do you have, and are you going to need all these deductions to offset that? Now, most of the case, right, it's usually going to be helpful. However, we're going to talk about in a second, the real golden nugget here is going to be the real estate professional. So before we get to the real estate professional, let's talk about, and I think someone asked before, who was it? Diane asked, which type of properties does it apply to? Well, let's talk about it here. We have apartments, multifamily. So this chart is essentially talking about the average reallocation of a cost segregation. Now, what I mean by that is we talked about there's different components depreciate faster, 5-year, 15-year property. On average, how much of that is going to be allocated to those assets versus the structure, which is the main thing, which is going to depreciate on 27 or 39-year schedule. So apartments on average, it's about 28% on average. So you have some which is closer to 20%, some that is 30, 35%, but on average, we're going to be looking at 27, 28% is going to be found in those faster deduction categories, those faster depreciation categories. Self-storage, which really should be in here, is also closer to that, around 30%. You see manufacturing facilities have a lot more equipment, so that's going to be on the higher end, et cetera. You'll have mobile home parks and RV parks really is off the chart. And the reason why that is because the majority of what you're really buying, besides for the land, is the land improvements. Okay, so mobile home parks, mobile home communities, RV parks, you buying the pavement, right? The concrete, the landscaping, and that's where a lot of the value of this is going. And literally I'm seeing, between 50 and 80% of that can literally be allocated to those faster lives. So talking about bonus depreciation, getting 80% back, well, if you're putting 20% down and getting, 3 to 4 times that back as a first year tax write-off, it's pretty crazy. So that's something You should be aware warehouses are on the lower end, specifically because there's really not a lot in there, right? There's maybe some shelving, some security equipment, maybe lighting, etc., but not much equipment or furnishings or anything like that. So these are different types of properties. But every type of property, like I mentioned, another one that should be on here is short-term rentals, which is Airbnb is very, very popular category. So if you guys have ever looked into investing in short-term rentals or Airbnbs, anyone here looked into that? Oh, look at that. She literally just asked that. I'm putting that post. Yeah, they should be on here. On average, I'm seeing about 25-30% of that. So that's awesome. So self-storage facility also has a great benefits, especially when there's climate control. That's a big ticket item that is going to be the HVAC units, et cetera, that are going to add value to the cost segregation. Yeah, event-focused boutique hotels, resort, those are great. Yeah, we've done a lot of those, and so many different types of hotels and different resorts, et cetera, are going to benefit. You can see, because there's a lot of furniture, fixtures, et cetera, the FF&E, that's a big category. So let's talk about this real estate. I told you this is going to blow your mind. If it doesn't blow your mind by the end of this, you can let me know. But this is something the IRS, this is directly from the tax, from the IRS's tax, what's literature, what's the word I'm looking for? From the publication, okay, called Real Estate Professional. I think it's publication 946. And essentially what it talks about is who can be called a real estate professional. And really all this is a line on your tax return that asks what's your occupation. Now, if you write real estate professional, right, you get this golden ticket. What does this golden ticket mean? Okay, let's first define it, and then I'll tell you what the golden ticket is. Defining it is that either you or your spouse, so only one of you needs to get this, to have this. And this is looked at on a year-by-year basis. You need to have two requirements. Number one, you need to spend more than half of your personal time, your time working in the real estate trader business. You need to be materially participating in that. So that means more than 50% of your time, but literally what it means is you can't have a W-2 job. You really need to be full-time in doing real estate. And number two, you need to spend at least 750 hours during the year in that trader business. So you can't just retire and sit on a beach and do nothing. You actually have to show some work. It's not a lot, 16 hours a week, on average, 3 months a year, et cetera, however you want to look at it. And what are these activities? So you have to be doing any of the following things: developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing, brokering real estate. So if you are doing any of these things, this qualifies you as a real estate professional. As I mentioned, you cannot have a full-time job, a W-2, and also qualify for this. However, your spouse can. And so this is a great strategy for many people, because, as I will describe now, is the time why this is the golden ticket. Okay, we mentioned before, everyone remember that rental income is considered passive income, and the deductions from depreciation and cost segregation is considered passive deductions. Those are going to go to offset one another. However, if you are not a real estate professional, you're just an investor or whatever, you have a job and you own real estate or you invest in real estate, your depreciation is going to be limited solely to your passive income. Now, passive income can include any rental income. So if you have a number of properties, they're going to be all lumped together on your Schedule E. If you have any passive investments of other kinds, which can be not stocks, okay, those are still considered active, but literally like business, if you're investing in a business or something like that, but it's passive, you're just a limited partner, that's also going to be considered passive income. There are certain other things, investments, that will all be considered passive income. Depreciation can be used against that. We actually had a speaker at our meetup a few weeks ago who talked about passive investments into equipment and into solar and things like that. That's all going to be considered passive income. It's still being Schedule E. The depreciation can be used against that. However, if you're not a real estate professional, it's limited. And so if you have more deductions than you have income, it's just going to be a passive loss and not going to help you. What I mean by that is, let's say in our example, you had $60,000 of income from your rentals and $250,000 in depreciation. Well, that's great. You pay zero income tax on your rental income, your passive income. However, that extra $190,000 is just a passive loss and is going to carry forward. You cannot use those extra deductions against your W-2. So if you're a doctor, lawyer, whatever it is, high paid individual, IT, whatever it is, you can't use the real estate, the depreciation deductions against your W-2 job. However, if you or your spouse are a real estate professional, you're no longer limited. You can use that extra $190,000 to offset any other source of income you have whatsoever. Okay, so this is really, like I said, the golden ticket that allows you to do the conservation on these, properties, get huge tax deductions, and not only that, not only use it to pay zero taxes on your rental income, but also to pay that, to use that against your active, your W-2 income, your spouses, et cetera. So that's the real golden ticket. That's what real estate professional is about. That's who conservation is really going to benefit the most. And so, as I mentioned before, right, like not all taxpayers are created equal. So yeah, great question, Diana. What if you're a real estate mortgage broker? Unfortunately, there are plenty of positions, including my own, right, where I'm involved in real estate all day long, right? A mortgage broker certainly is as well. However, unfortunately, you are not considered by the IRS to be a real estate professional. Again, they created these specific activities, and these activities alone are going to be, specific to owning real estate or managing or involved in the actual rental property itself, and not just the mortgage side of things, which is really more involved in the debt side of things. Unfortunately, I wish it wasn't that case, for selfish reasons as well, because again, I'm involved full time. However, I'm not a real estate professional, but hopefully this year, next year, I might be. So we'll see about that. But again, this is something that I know literally many couples who have had this discussion. They're like, okay, let's look at our joint income. If one is earning a very high income and the other is also, but if you're investing in enough and getting enough of these tax deductions, you may actually bring home in net income more by using the real estate professional status, getting those tax deductions, and and only one person is working versus both working full-time and paying high tax brackets. So this is a category that, a conversation that I've seen happen. And I've seen many people make that jump to go, full-time into real estate for this specific purpose. And it's definitely worth it. So again, this is a huge tax benefit. I wanted to spend a little extra time on it just because it is so powerful and so important. So when should we be doing it? Okay, so we talked about who, we talked about what, we talked about why, right? We even talked about how a little bit. What about when? When should we be doing this? Now, a lot of people like to reach out before they buy a property and just figuring out who should, when is the best time. Now, people reach out when they're under contract, right? Leslie, reach out all the time. You're under contract, getting this done. What, we want to get an estimate, we want an analysis. And so we run that, no problem, run the estimate to show you what the potential tax savings will be. But you're only going to do the actual study once the property is acquired, because, you're going to get the benefits only starting, again, remember, the depreciation starts when your property is placed in service, meaning once you start renting out, once you own it. And that 27.5-year schedule starts day one when you close on the property. So that's usually the best time when people reach out. Oh, we just bought this property. Let's get it done. It needs to be done for that, tax year, but it does not need to be done in the first tax year. And that's really important thing, meaning you can say, well, maybe I don't need the extra tax deductions this year. What about next year? Or a year after? Maybe I'm going to have a lot more income at that point. Maybe I'm going to have a big capital event at that point. I want to get those deductions at that point. You can get it done. Or on the flip side, maybe you just didn't know about conservation and you've owned rental properties for a few years and like, well, can I go back and do it retroactively? The answer is yes. So that's going to be called what we call a look back study. And that is done without even amending your tax returns. The great thing is you don't need to amend your tax returns. You can just go forward, change the depreciation method, and we can basically catch up whatever depreciation you missed that you could have taken previously. And that's what we, a really great benefit of conservation as well, that you can use it when it's best for you, right? Maybe it's not best right now this year, but it will be best in a future time. And so that's the strategy. But again, most people get it done in the first year, right? You want to get those tax benefits right away. And especially now with bonus depreciation, being phased out and 2022 being the last year to get the 100% of that, you want to make sure to get it done this year, because if you get those extra losses, you can still carry it forward. You're not going to be limited on those losses, but doing it the first year, the 100% bonus is going to be limited starting next year. The second time when you're going to be doing this, or another time, maybe when you're doing a major renovations. And so, as I mentioned before, the deductions of depreciation begin and are totally based on the purchase price. And it doesn't change if you get it appraised. Let's say you get the property appraised and it goes up in value. That does not change the book value, basically, of the depreciation. We call it the tax basis, the amount that you can depreciate. The only time it's going to change is when you add more money into the property by doing renovations, value add, et cetera. So when you're doing those major renovations, you can get the cost segregation done as a follow-up, not just on the purchase, right? Get that done. But then after you finish the renovations, whatever money was spent on that, you can take that as a tax deduction as depreciation as well. And certain of those components are going to be on, the structural components if you're doing some structural work. But a lot of the renovations oftentimes are going to be in these faster categories, like the land improvements, putting in new landscaping, a pool, pavement, repaving the parking lots, et cetera. The interior, right? Putting in new countertops, new cabinets, new appliances, et cetera, new carpeting, flooring. All of that is going to be depreciating on a 5-year faster schedule. So most often, the actual benefits from the renovations are a much higher percentage than the benefits.
Yonah.
Yeah.
Yonah, sorry to interrupt the meeting, but Yonah, you are looking mad cute today. Like, no cap. Like, you're getting me bricked up right now. Like I'm not trying to make this like weird or anything, but like, bro, you're getting me bricked up right now. I can't
Okay.
control it. I'm so sorry. I just wanted.
I'm not sure who that was. Okay.
I'm sorry.
Is that you guys know who that is?
I'm not
Wanna
sure.
hear? Okay.
I'm not sure, but yeah, continue, Yonah. Thank you. Thank you, whoever made that comment. I think it was just a compliment to you, Yonah.
Yeah,
Just,
that's fine.
Receive it and let's move on. Yeah, thanks.
Okay, fine. So again, what we're talking about here is the benefits from the renovations are much higher percentage than the actual purchase. Okay, so that's going to be what we're looking at, and it can be done on a new construction as well. So make sure you guys know when is the best time to do this. Again, new construction, definitely, but when you're doing the acquisition, number one, and then secondly, more importantly, if you're doing major renovations, that's when you're going to want to get the cost segregation done. Okay, and last but not least, let's jump right into this case study over here. Okay, so we have something that is, when we're dealing with cost segregation, we want to know what are the real numbers. Now I gave you some numbers, right? But I didn't actually show you. So I'm going to show you, and I'll tell you a little bit of a story because this is important. This person bought a 32 unit, was 1.75. This was a couple of years ago, but it was his first after many single families. And why I'm mentioning that is because this person, and this is going to be really important to remember later on, this person didn't wanted to do what's called a 1031 exchange. Now, you guys know what a 1031 exchange is, probably. If you don't, put in the chat. We can explain what that is. Yeah, that was definitely entertaining. You can put in complaints there. Anyways, that was I'll have a story for another time. Never happened to me before. But this was his first multifamily within many single families. He wanted to do a 1031 exchange, sold off a bunch of single families going to full-time into multifamily property. And what happened? Failed the 1031 exchange. Now, 1031 exchange, without getting into that, is an incredible tax strategy that allows you to sell a property and buy another one without paying capital gains tax on it. But there's a lot of hurdles you have to kind of jump through, time windows, et cetera. This person didn't meet those time windows and basically lost out on that ability and was going to be hit with this huge capital gains tax bill on the sale of the single families. The reason why I'm mentioning that is because he did a cost segregation, and as we'll see shortly, he was actually able to offset the capital gains tax with the cost segregation deductions from depreciation. So it's not just for your income tax, it can also be used against capital gains tax specifically from real estate. Okay, so it has to be passive gains from rental property. So without cost segregation, he would have had $54,000 a year of depreciation. Again, that's straight line dividing, right, taking off for land and then taking it straight forward. What we did was we reallocated everything. So we had about 72%, again, 15% to land, 72% to the building, and then 8% to 15-year, that's the landscaping, land improvements, et cetera. And then 20% of the total property was going to go into the actual the personal property, 5-year property, et cetera. So at the end of the day, he had $421,000 in deductions. Now, this property was making some good money, over $100,000, but he was left over with this $300,000 with the bonus depreciation, $300,000 tax loss, which he could have used against other income, but he also used it against that capital gain tax. And so that was a big benefit for him here. And so I just wanted to point that out. This is an incredible story about someone who was able to benefit from the cost segregation, not only to offset their income tax and pay zero income tax, but also against a failed 1031 exchange. And so know that there are options out there. If you ever come across an example where like you can't do a 1031 exchange, what do? Guess what? If you can do a cost segregation the same year, you can actually benefit that even more. So Shaheen asked if I can elaborate on this page a little more. Yep. I'm assuming this page. So again, what we're doing with the cost segregation is allocating the property, right? That's what the cost segregation is. We're segregating the cost into different categories. And as we mentioned before, land does not depreciate. So the first thing we're going to do is off that purchase price, we're going to take off 15% for land. Okay. And the remainder of the building, right, we're going to divide into 3 categories. And this is not just a dividing, it's a engineering analysis of every detail of the property. But at the end of the day, we create this report and count these percentages. What is the real deductions that are going to be allocated or segregated to these different costs, allocated to these different components. So 27.5-year property, that's the main structural components, as we mentioned: windows, doors, roof, floor, foundation, right? Structural infrastructure, all that stuff. That's where the main value, because that's what costs the most to build. And then the 15-year is the land improvements, landscaping, pavement, et cetera. Okay, so that's, we found 8%. And then the 5-year property, again, once again, is the 5-year personal property, things that are non-structural, that are inside. So we're talking about furniture, fixtures, appliances, carpeting or vinyl flooring, cabinets, et cetera, millwork, even stuff like that. So at the end of the day, $421,000 was his first year tax benefit. And he was able to take that not only to offset the income tax that he had from the, over $100,000 of net income from this property, but also the extra losses could be used against his failed his failed 1031 exchange. And I see Sudip asked a question over here as well. If you're not able to suddenly execute a 1031 exchange, property A, but sell it anyways, you can do a cost seg study in property B that you still own and plan to hold for more years offset. That is correct. If it is in the same year, so it must be done in the same year, the cost segregation, getting those losses in the same year as the gain, the capital gain from the sale of the property. So yes. What should be going into a cost segregation study? So this is, so Han asked the question. Yeah, I mentioned this at the beginning. The land allocation is not always 15%. It is different for different assets, and it is different upon location. So certain locations, the land value is going to be higher than others. Certain is going to be lower. I just use 15% as kind of, an example. That was the case for this person. It's a national average, and it's a pretty safe assumption. But you do need to know your specifics, because if you end up having, like I had today, a woman who had a property, it was a beachfront property, and then ended up looking at the property tax assessment, and it was 50%, like 52% was land value. That really bit into her depreciation deduction. So, because again, more is going to be allocated to land, less is going to be allocated to the depreciation. So this is taken directly from the cost segregation audit techniques guide over here, where, if anyone's looking to find something to read, definitely go for it, especially if you have insomnia. It's a great read over there. But you go to IRS's website and you can check it out. And essentially what needs to go into what's called a quality cost segregation study, it needs to be done by an individual with expertise. So again, that's where the engineering component is coming. They have more specifics in the actual these are just kind of paragraph headings, but in the actual breakdown of this, it says someone with engineering or construction experience. There's a whole description, there's a whole, documentation, there's a whole nomenclature, numbering system. So it is a very detailed process. We create, an 80, 90-page report, which in it has all of this, the legal analysis, the identification to the tax code of every individual, component, et cetera. So it is very detailed, but in the end of the day, all you're getting is from that one page in this report that has your new depreciation schedule. And that's what you're going to hand off to your accountant, and they just plug in those numbers. It's a one-time thing you do, and you're good to go. So, a little bit about us that you don't really need to know, but we're the biggest national cost segregation company. It's actually an old thing. We're over 20,000 studies now, and well over 3 billion, probably 4 at this point. But again, disclaimer, we're not offering advice. Seek your own advice. And this probably should have been at the beginning, but that's all. And if anyone has questions, now would be the time. Or more questions, I should say. You guys had awesome questions until now, so this has been a lot of fun.
I think somebody was asking, actually, you answered the question about the bonus depreciation and when that ends and that steps down over the next several years.
Yes.
I think somebody asked that earlier, but this was once again, an amazing, fantastic presentation. Even I learned additional stuff. I feel like every time I listen to you talk, Yonah, I learn another little gem and little piece of this stuff. So
that's great.
It's always incredible to hear that. But I think some questions are coming in right now. Brian was asking, 15 and 5 year segregation can be taken in 1 year for 2022 at least.
Yeah. So again, the bonus depreciation is going to be those categories that depreciate on a faster schedule. So that's the 5-year property, the 15-year property. You can take that all up front in the first year, and that's called 100% bonus depreciation. And in 2022 is the last year where you're going to be able to take 100% of that in the first year. Otherwise, it's going to be, after that point, it's going to start phasing out.
That's it. And Diane Stein was saying, what if I've owned the property for 16 years?
So if you own it for 16 years, and I know we mentioned earlier that you can actually benefit from this going backwards retroactively. If you've owned a property for 16 years, you've already depreciated the majority. So there's not going to be much left, that you can now go back and reallocate, right? You've already taken so much depreciation. However, if it is a very big property, a very expensive, a huge property, then even a small amount that you can front load and you can get as a tax deduction this year, it still can be done. You can still catch it up. Typically, I find, 5 to 6 years, that's really where it's going to be kind of the cutoff point for most of the time. But again, if it is a big enough property, it can be beneficial. I did once like a $300 million property that people own for 12 years. And, yeah, sure, they depreciated almost, half of it already, but there was still a large chunk, to pull up.
Yeah, I think Dr. Shiraz Suleiman is about to talk, but Diane just followed up our question saying that how about if she repaved or put in a new parking lot? Is that something?
Yes. Yeah. So again, anytime you're going to be doing renovations or doing new work, that is going to be different from the cost segregation on the original asset. Okay. Putting in new work, that can be depreciated separately and that can be depreciated on its own. So the repavement is going to be 15-year property. And you can do that if it was after, 2018 when the tax form, you can do that as bonus depreciation as well.
Excellent.
A lot of great questions here. Thank you guys.
Excellent. So I will pass it on to Dr. Shiraz Suleiman. Can you please go ahead?
Thanks, Julius and Yonah. Wonderful presentation. I just want to ask you, when should we be doing this analysis, and what the rough approximate cost? Does it vary depending on the properties? And do you have to repeat the analysis after a year or a couple of years? And what challenges are there from a tax point of view? Do you see like the pushback from the analysis?
Yeah, so excellent questions. So let's just try to knock those off. So number one, it usually, when should it be done? Like I said, people like to get it done as soon as they buy the property. It can be done at any time though. How much it costs really does depend on the type of property and the size of the property. It's not based contingent on the tax savings. So we have a flat fee, but it is based on kind of square footage and the size of the property. Typically, in the range of about, I'd say 4,000 to 6,000 is on average. There's certainly properties that are going to be a little more than that. Some smaller, maybe single families, a little less than that, but on average, somewhere in that range. And in terms of the pushback, there is no pushback because this is directly from the tax code. And in fact, the IRS considers conservation to be the correct method of depreciating your property. They just don't require you to do that because that would, make you allow you to, require you, to get a third party and pay extra money, et cetera. So they don't require you to go out of your way to get extra tax deductions, but it is considered the proper way to do that. And the last question I think you had was
actually, I think somebody was asking at some point also if we were going to share the slides. We're actually going to send a copy of this video to everyone who registered for this, so they will be able to take advantage of that just for that person.
Awesome. Okay.
And I think there was a question about, is the threshold for a single family about 500K?
Yeah, the threshold, it's a really interesting question when we talk about the threshold. As we mentioned, it's really a percentage of the purchase price where you're going to be getting this tax benefit, right? So I usually like to say $500,000 is like anything over that, it's a no-brainer because the tax benefits are so great. If you're a real estate professional or you have other reason that you're going to need these extra deductions, it can even make sense on a smaller property, especially if it's like an Airbnb where you own a lot of furniture and fixtures. You're going to have a lot more percentage of tax benefit, whereas a regular single family is much less. Anyone else had a question? No, the crasher, you can keep them in. That was kind of
actually, that was hilarious. But thank you so much, Yonah. I think we're up on time. We actually kept you past time, but I just can't say thank you enough for gracing us with your presence and once again sharing these incredible insights with us. We certainly look forward to seeing you again on this meetup. I never get tired of listening to you talk about this. So let's continue to grow together. And for those of you that are on, please still stay put. We still have a few more minutes, and we'll talk to you a little bit about some of the exciting opportunities that XSITE Capital has on. And then for the rest of you also that want to talk to the entire group and interact a little bit, I would ask for you to come on camera. Anyone who's on camera gets to get introduced first, or introduce yourself first and talk a little bit about what you do. So that's like hopefully some good incentive to see your beautiful faces. Once again, Yonah, we say thank you for coming and share this with us. We look forward to seeing you again soon.
Yeah, thank you. And thank you all for the wonderful questions. I love it. Appreciate
it, Yonah. Yeah. So yeah, for the folks that are still on, we really appreciate you. It's about time that we typically would pull people onto the cameras and have people kind of introduce themselves, talk about what they've been doing with real estate. But before we do that, our fantastic director of operations and co-founder, Mr. Leslie Awesome, is going to talk briefly about our current deal. And the amazing opportunities that this could present to you to take advantage of some cost segregation amongst other fantastic advantages of this particular property. We almost completed with the raise for this because the close date is the 3rd week of February. So, but we still have a few spots left, and hopefully look forward to bringing you on if you think this is a good fit for your portfolio. So Leslie, take it away.
Again, thank you, Julius, and thank you everybody for staying on and coming joining the presentation. Again, welcome to the exciting world of multifamily investing meetup, and welcome to the community. This is our most recent acquisition that we have under contract, and we'll be closing in a couple of weeks. His land bank lots 113 units in Columbia, South Carolina. This is a Class A asset right in the smack middle of Columbia, South Carolina. As you can see on the screen right here, this is the asset, the big white building there. And next to it, that glass building is Prisma Health. It's a hospital, one of the biggest employers in Columbia. That is right next to this building. The location of this building is so wonderful. We're really grateful and excited to be able to have this. And we also got the cost segregation report from this, and you're able to get 100% bonus depreciation on this asset, which translates to about 40% of your initial investment. So a $50,000 investment, you're going to end up with bonus depreciation year one of about $21,000, which you could use to apply to your portfolio income or any of your other passive incomes as well. And the great thing about this asset is it's a Class A asset with a little bit of value add and has returns similar to like a more Class C asset. We are projecting a 19 to 25% average annual returns conservatively, and a 15 to 18% IRR conservatively. That's a 2.3x to a 2.7x more equity multiple on this deal. We went into this deal with a lot of conservative underwriting, considering the climate that we are in. We underwrote this deal with an exit cap rate of 5.7%, whereas the market right now for Columbia Class A property is about 4%. So we're underwriting this deal about 170 basis points away from the market cap rate, which protects our investors from any changes that may happen into the economy. And like Dr. Julius only said, there are a few slots left in this deal. So if you want to take advantage of the incredible returns and the incredible tax benefits, don't hesitate to use the link below, and you could review and submit the soft commit, and we'll reach out to you and learn more about you and see if this is a good fit for your portfolio, or answer any questions you may have about the deal as well.
And I just posted a link with the direct offering detail right there in the chat. Oh yeah, there you go, Leslie. You posted the same link too. That's fantastic. That's beautiful. So, I mean, this is a fantastic deal. I've been talking about it for the past, however long when we have had it under contract. I'm super excited to see it kind of wind into a nice hand at this point. And we are super excited to have anyone who wants to join us on this journey with this particular deal. I know some of you already are investors, and some of you already invested in this deal. So for those of you that have taken that step, it's going to be a fantastic ride, and I look forward to meeting and surpassing the projections on this one. For those of you that are still thinking about it, certainly if you have any questions, reach out to us, and we'll be happy to answer those questions for you. With that, we'll move forward. We'll move on to the networking aspects of this meetup. I think right now all I see is Leslie and I on video. And if there's anyone else who wants to come on video, introduce yourself, introduce what you've been doing with real estate or otherwise, or what some of your interests are. If you don't have any real estate holdings yet, this is a great opportunity to do that. If no one comes on video, then I guess we could just have anyone who is interested, even if you don't want to come on video, just introduce yourself and talk a little bit about. Oh, there you go, Dr. Shiraz Suleiman. Go for it.
Thanks, Julius. I'm from Toronto, so I belong to a group of physician investors. So I'm the only guy outside the US, I think. We do lots of deals here. We've done passively, but now I'm interested in building my network and meeting people like yourself and others in this group to network and get involved in syndications, LP, GP, co-syndicate, anything. And as I build my network, I just connected with Leslie. I see. Thanks for the connection, Leslie. And I appreciate having the opportunity to introduce myself. Thanks, Julius.
That is exciting. Always exciting for me when I see other medical professionals who are interested in expanding their mindset and they're exploring this asset class. Because when we go to a lot of conferences, we do see a lot of CPAs, we see a lot of lawyers, we see a lot of MBAs, business folks, we see a lot of finance folks. And and for some reason, healthcare professionals are usually underrepresented. So finally, I think we are breaking out of our silos and finally engaging with growing and accelerating our wealth growth in this asset class too. So that's always exciting for me to see. It was one of the motivations certainly for starting XSITE Capital. And every time I get that opportunity to meet folks like yourself, it warms my heart. So welcome. And we look forward to seeing you more on this platform.
Thanks very much. I just want to say that you're right. We are rare in this market, and I'm excited to see that you're an orthopedic surgeon as well, which is fantastic. At least we are starting off as brothers in the healthcare field.
Absolutely. Yeah, so that's awesome. Yeah, any other person want to introduce themselves? Oh, awesome. Well, don't be shy. I know Han is there, and it's dear friend and investor. We really appreciate you, Han. You want to say a few things? Oh, there goes Bernard. Bernard just came on.
Yeah.
Bernard, you want to say something?
Yeah, absolutely. I would like to introduce myself. It's my first time on this Monday meeting. Can you see me? My camera's not working really well.
I think you look a little ghosty on the video, but we kind of see the outlines of your face, and that's pretty good. We could take that.
Okay, not a problem. So yeah, so I'm in Fort Lauderdale, and I'm a real estate agent full-time for the past 10 years. I represent folks on the residential side, and also I've been investing in real estate for the past 8 years, actually, buying properties, single family homes, renting them out, fourplexes, and also Airbnb as well. So just got, just this, I would say about 4 months ago, I thought about syndications and reached out to Leslie. I'm surprised Leslie didn't ask me how I got his phone number, but I saw him on a podcast with, I think it was Rod, and I skip trace his name. The same way I would skip trace absentee owners, that type of thing. And he called me back. So that's how I got your information, Leslie. If you didn't know, I actually skip trace your name through the system that I have to find sellers.
Awesome.
And you called me back, and we have this relationship going. But yeah, I like the asset that you guys have, and it's something that me and my wife is looking to jump on. So if I can make it before that time and jumping on that deal, I'm excited.
That's fantastic. That's fantastic. Thank you so much, Bernard. I really appreciate you joining us, and certainly look forward to seeing you again in future meetups. We realize your interest and we welcome it. And there's definitely going to be great opportunities for us to collaborate far into the future. I think Jay came on, and then it's Han. So Jay, please go for it.
Well, I came on because so many people were off camera, and I felt guilty. But
it's all good. We don't mind at all. I mean, everybody's kind of busy, particularly at this time of the evening. So it's completely understandable. But thank you so much. I have to shout you out. You were the one who quickly realized that intruder and identified him or I'm not sure what it was, but for what he is. But that was really interesting. I've never seen anything like that before. So. But yeah, we kicked them out pretty quickly, with very swiftly. So thank you. And for all your engagement in the chat. So yeah, Han, you want to say something?
Hey, Julius, Leslie, and Tenny, thanks for hosting this meetup. It was another great session, learned a ton. I'm just here to network, continue learning. I've been in commercial real estate and a CPA for over a decade, but try and get assets on my own and as an LP or grow into a GP. That's kind of the progress. That's kind of what I'm aiming for. So got a short compressed time frame that I want to hit some of those financial goals and make a bigger impact.
Well, let's do it. Let's do it, hon. Let's keep working together. Maybe we could take down some deals together.
Yes, sir. Looking forward to it. Appreciate it.
Awesome. Awesome. Tenny, are you trying to say something? Is that why you came on?
I just came to a point where I could actually come online and you guys can see my face very well. So thank you everybody for joining. This was a great session. Learned a lot as always. So great to see you all.
Awesome. Awesome. And is there anybody else who wants to say anything? If not, no worries. We could give you about 15 minutes of your life back, except if you really want to say something or communicate about something. The group that I just have a quick question though before I call it, if no one has any questions.
Can I ask a question, Julius?
Yeah, please go ahead, hon.
Is there anyone in this group that's actually taking advantage of that real estate professional status and being able to utilize all that bonus depreciation to offset their W-2?
That's a
Because if
great
there are,
question.
I'd love to hear your thoughts.
That's a great question right there. Thanks, Kudip. I saw your chat entry, but go ahead. Is there anyone who has taken advantage of this, of real estate professional rep status? I know my two partners are on their way to achieving it.
As Yonah was going over it, I was scratching my head.
How are you gonna do it? Yeah, it seems like you have to be relatively active in one of those things, and even for those of us who manage managers, it may be tough to achieve it. I think the entity is the real estate, entity, and individually, I think we'll probably need to be more active in the management and maybe acquisitions and things like that. I'm not sure how that works, but I think
so. One of the things I'm doing is my wife is trying to get a real estate license so that she can buy some properties and get active in that aspect. Actually, she's in the real estate class right now. I'm with the kids. So this year is one of my goals to try to have that real estate status, because I still have my W-2 job and I'm doing XSITE Capital as well. But like Yonah had mentioned, if you have a W-2 job, it's going to count against you. So my wife is looking to get the rep status, and hopefully this year we can qualify for it.
that'd be awesome. Yeah, but I guess the answer to your question at that point is no one on the call currently has achieved real estate status, rep status rather. I try to convince my wife to do it, but she's not having any of it at this point, so I've given up. Yeah, so,
You may need to listen to Yonah.
I know. So yeah, but I think if you have a spouse if you have a W-2 and if you have a spouse that's willing to do it, or that's interested in it, I think it could be magical for sure, particularly for highly paid skilled workers like some of us. Jay put some things in the chat about a fund. That's awesome. Great. Event focused. You want to talk a little bit about that, Jay?
We're doing the 3 consistent models in a scaling international model. One franchise is already an international franchise. We have a lot of international interest. I work with Wealth Migrate that vets. This includes your project as well. They vet investors for U.S. projects so that the projects that their international investors invest in are safe as U.S. projects. And by the same token, vet international investors for U.S. projects so that it goes both ways and everybody's covered and helping to develop special, SPVs as an entity to protect investors within a fund or within your organization or your project. And that's just, for example, I mean, separately, it's just we're starting to scale in Florida, but we're open to all seasonal climates because it cash flows regardless. But we're going to keep the mild climate properties within the fund, but the model itself can be licensed to more seasonal climates.
Got it. Got it. Cool. That's awesome. If anybody is interested, please contact Jay's. Jay's dropped a contact right in the chat. Please reach out. Are there any other questions or comments? No? Okay, well, I think I'll give you 10 minutes of your life back. We really appreciate you all joining us. We don't take it for granted at all because you could be anywhere else in the world, but you're here with us. So we appreciate it deeply, and we look forward to continuing on this trajectory of growth and wealth growth and mind growth and this exciting journey with you all. So we look forward to seeing you again. And just remember, we have this meetup every Monday, first Monday of the month. So we'll have another one coming up in March, the first Monday of March. So stay tuned for the guest for that particular one. And for Dr. Shiraz, please drop your number. I will definitely reach out to you and just give you a call right now. And the rest of you, I really, really appreciate you all. And we look forward to seeing you soon. Take care now.